Your organization will be disorganized if inventory is not managed accurately and harmoniously. Become aware and conscious of your capacity for stewardship. Stewardship of resources enables growth over the long.
Inventory management is pivotal for business performance and profitability. Efficiently handling inventory levels enhances operational efficiency and financial strategies. Poor management can result in financial losses, stock imbalances, delayed order fulfillment, and dissatisfied customers. This chapter discusses inventory management frameworks, focusing on objectives, techniques, and best practices. The primary goal is to balance overstocking and understocking, ensuring adequate working capital while optimizing costs. The chapter delves into various inventory management techniques, aiming to effectively control and manage inventory. It particularly sheds light on two pivotal techniques: vendor-managed inventory, VMI, and just-in-time, JIT. VMI reduces inventory levels and improves fill rates, enhancing supply chain performance. On the other hand, JIT minimizes excess inventory and improves material flow. Both techniques present challenges and benefits. Accurate forecasting is highlighted as a best practice, aligning production with demand, reducing carry-on costs, enhancing cash flow, and streamlining the supply chain. The literature is reviewed, emphasizing inventory management's role in the broader context of supply chain management. Modern business management no longer competes as independent entities but rather as supply chains. Mensa 1 defines a supply chain as a set of three or more entities, organizations or individuals, directly involved in the upstream and downstream flows of products, services, finances, and/or information from a source to a customer. The supply chain is not only a chain of businesses with one-to-one, business-to-business relationships but also a network of multiple businesses and relationships. 2. Supply chain management, SCM, encompasses the flow of both materials and information within the supply chain, with the latter directly influencing internal activities such as production scheduling, inventory control, and delivery plans. 3. Effective supply chain management decisions can result in cost reductions for organizations, including transportation, sourcing, stockouts, storage, and disposal costs. To achieve these benefits, supply chain members must recognize their role within a complex network and understand the interdependencies between chain participants. The overall objectives of SCM are to improve the company's profitability and performance, to reduce the costs mainly by reducing the inventory level, and to maximize the overall value generated to the customer. 4. In the context of supply chain management, the integration of inventory management is essential. Efficient inventory management ensures that the right products are available at the right time, preventing stockouts and overstocking. 3. This synchronization enables organizations to respond promptly to changes in demand while minimizing excess inventory costs. Inventory management presents numerous challenges for many supply chains, as they are becoming more complex and composed of multiple stages. The goal of inventory management is to increase customer service, enhance product variety and availability, and minimize costs. 5. Achieving efficient supply chain operations relies on well-defined inventory management policies that facilitate reduced excess inventory levels throughout the entire chain. 6. This section will offer an overview of inventory management aspects that have been identified in prior literature. Research on inventory management is crucial and has consistently held a central role in various academic literatures. Scholars from diverse fields have published articles that contribute to the advancement of inventory management theory. Inventory is commonly understood as being synonymous with stock. Stock refers to tangible goods that are subject to processes such as mining, conversion, creation, transportation, and sale. 7. Inventories include raw materials, work-in-process goods, and fully finished products, comprising a business's assets that are either prepared for immediate sale or intended for future availability. 7. Selecting an appropriate inventory model is regarded as a significant challenge for industries. The earliest scientific research on inventory management dates back to the second decade of the previous century, yet the continued interest in this scientific field remains substantial. 8. Inventory management is defined as an ongoing procedure involving the planning, organization, and control of inventory. 9. Its objective is to reduce investment in inventory while ensuring equilibrium between supply and demand. The objective of this process is to decrease procurement and carrying costs, all the while upholding an optimal product inventory level to satisfy customer demand. Inventory management tracks stock trends, ensuring timely ordering and customer order fulfillment while preventing shortages. Inventory transforms into revenue upon sale, but while unsold, it ties up cash, and excessive stock diminishes cash flow. 5. Effective inventory management entails weighing inventory costs against its benefits. Inventory management's primary advantages include enabling order fulfillment and increasing profits. 10. Inventory offers numerous advantages. It enhances customer service through reduced lead times, fosters organizational flexibility, cushions variances between input and output rates, accomplished by bulk ordering or manufacturing and selling in smaller quantities, and evens out manufacturing burdens for organizations dealing with demand fluctuations. 7. Additionally, it serves as a repository for potential capacity that might otherwise go to waste. Inventory also has disadvantages. It ties up working capital and space. It can suffer from obsolescence, deterioration, and shrinkage. It can lead to administrative complexity and can mask inefficiencies. Inventory management is widely regarded as one of the most critical challenges in organizational management. Typically, there is no one-size-fits-all solution. The circumstances vary for each company or firm, encompassing distinct features and limitations. 8. In the present day, numerous inventory management techniques are employed by companies with the intention of gaining control over their inventories. However, not all these techniques are universally applicable to every industry. As a result, despite the multitude of approaches available for inventory control, selecting an appropriate one that aligns with a specific company remains a formidable challenge. Within this chapter, we will delve into several of these techniques and elucidate the significance of each. Inventory management is a specialized branch of business management that involves the strategic planning and control of inventories, aiming to uphold the ideal stock quantities for certain products or items. 11. The challenges of inventory management revolve around the balance between excessive stock and insufficient inventory. Effective inventory management is crucial due to its direct impact on operational efficiency, customer satisfaction, and the financial objectives of an organization. As the number of stages in the supply chain increases, the complexity of managing inventory also rises. Handling inventory within a multi-echelon supply chain is notably more challenging than overseeing it within a single echelon structure. 12. In businesses, especially those involved in manufacturing and production, a substantial number of financial resources are typically directed toward inventory. This allocation of funds can sometimes exceed what is dedicated to other assets within the organization. Consequently, inventory management emerges as a central player within the realm of supply chain management activities. As previously noted, the fundamental objective of inventory management encompasses ensuring an uninterrupted supply of materials to sustain production during customer demand, while avoiding both overstocking and understocking. This approach aims to maintain the necessary working capital for operational and sales activities, optimize various costs such as carrying, ordering, and storage costs, eliminate duplication in stock orders, provide a continuous flow of required materials, and contribute to price stability. In essence, effective inventory management serves the critical purposes of supporting consistent production, cost efficiency, inventory management is associated with costs that exert a direct influence on the value of inventory. 13. Three. 1. Carrying costs. Among the challenges of inventory management, carrying costs stand out. These costs arise from the storage of products in warehouses, distribution centers, or stores. They encompass expenses such as storage fees, labor, transportation, handling, taxes, insurance, and depreciation. In essence, carrying costs constitute the total expenditure invested in stocking and storing products and items prior to their sale. 3. 2. Ordering costs. Ordering costs pertain to the expenses linked with placing orders for new inventory. This includes transportation, shipping charges, inspections, and other expenditures related to the order process. 3. 3. Stockout costs. Stockout costs encompass both direct and indirect expenses that a business incurs when it faces a shortage of stock. Recognizing the substantial impact of these costs on a company's margins, revenue, and overall profitability is crucial. 3.1.2 Optimal inventory levels. Balancing on-hand stock is a central challenge faced by most businesses. Achieving optimal stock levels necessitates alignment with actual customer demand, ensuring that quantities are consistently available to meet that demand. Simultaneously, maintaining excessive stock levels can lead to a host of adverse consequences that negatively impact cash flow and profit margins. 3.1.3 Demand forecasting. Another main challenge for inventory management is demand forecasting, which involves anticipating inventory needs. Supply chain forecasting goes beyond the operational task of estimating demand requirements at each level of the supply chain network. It involves complex issues such as supply chain coordination and sharing end customer demand information among members. Consequently, numerous forecasting techniques have been investigated to assess their impact on inventory management in the supply chain. Researchers have extensively examined methods such as moving averages, exponential smoothing, and minimum mean squared error. Demand forecasting plays an important role in balancing inventory levels and consequently affects inventory management. 3.1.4 Lead time management. Lead time represents the time difference between when a customer places an order and when the product or service is delivered. It serves as a crucial factor for calculating demand during the lead time, also known as safety stock. 3. In short, lead time is the duration it takes for an order to be fulfilled. Lead time can significantly impact the decision-making process when purchasing products, as longer lead times can cause companies to become apprehensive and order excessive amounts, ultimately leading to an accumulation of excessive stock. Three point two Inventory management techniques. Inventory management is an immensely significant function for any business. If not done well, it can cause serious problems. Poorly managed inventories can lead to production delays, unhappy customers, and less available money for the business. Inefficient inventory management can result in production delays, customer dissatisfaction, or even a reduction in working capital. 14. Many researchers have looked into different ways to manage inventory effectively. In this chapter, we'll concentrate on the techniques most frequently discussed in the literature. 3.2.1 ABC Inventory Classification Technique. The ABC inventory classification technique is widely utilized by large firms to efficiently manage a significant volume of inventory items. This method involves the categorization of inventories into three primary groups: A, B, and C. Items designated as A hold the highest level of importance, whereas C items are deemed to be of lesser significance. The classification of items follows a hierarchy where Class A items represent the most crucial, followed by Class B items, and finally, Class C items, which are the least critical. This classification system plays a pivotal role in prioritizing inventory items based on their stock levels and reordering requirements. Moreover, it simplifies the arrangement of inventory items based on their respective values, demand, costs, and risk data. 15. 3.2.2 Just-in-time, JIT. Inventory management technique. The concept of JIT originated from the Toyota Motor Company in Japan. JIT represents an innovative approach to inventory management, fostering a supply-demand system that promotes streamlined production and aims to precisely align demand with supply. 8. JIT systems are designed to rapidly respond to demand fluctuations, eliminating the need for excessive inventory. These systems replenish inventory and trigger reorders for future resources once a predetermined minimum threshold is reached, signaled by an indicator that denotes the necessity for additional stock to fulfill current demand. The core principle revolves around delivering goods precisely as promised when an order is placed by the customer. In manufacturing, the JIT philosophy extends to a Japanese management approach that revolves around ensuring the right items of optimal quality and quantity are available in the right location and at the right time. 16. JIT inventory management is an approach whose goal is to eliminate inventories rather than simply improve inventory quality. Raw materials and work in progress are reduced to equal the quantity required for a day's production. This is achieved by reducing planning time and lead time, allowing for smaller packaging. Suppliers may be required to deliver multiple items per day or near the utility facility to support this process. 10. 3.2.3 Economic Order Quantity, EOQ. The order quantity that minimizes overall costs is referred to as the economic order quantity, EOQ. This quantity strikes the most efficient balance between ordering and holding costs, making it a crucial parameter in inventory management. The concept of economic order quantity, EOQ, revolves around determining the optimal order quantity that strikes a balance between inventory holding costs and reorder costs. 17. This model has proven to be invaluable in resource optimization, leading to significant cost reductions. The EOQ model involves a careful consideration of the trade-off between ordering costs and storage costs when deciding on the replenishment quantity for item inventories. When opting for a larger order quantity, the frequency of ordering is reduced, subsequently lowering ordering costs. However, this approach necessitates maintaining a higher average inventory, consequently elevating storage, holding costs. Conversely, choosing a smaller order quantity reduces average inventory levels but results in more frequent orders, leading to higher monthly ordering costs. 3.2.4 Safety stock. Safety stock refers to the average amount of inventory held on hand to account for short-term uncertainties in both demand and supply variability. 18. In simpler terms, safety stock represents the inventory maintained to prevent instances of stockouts and backorders. Its purpose is to safeguard against various deviations, including discrepant size and delivery dates, when replenishment lead times vary, variations in requirements arising from inaccurate forecasts, differences in delivery quantities stemming from insufficient vendor supply or subpar material quality, and discrepancies in inventory levels, when disparities arise between planned and actual inventory. 19. 3.2.5 Vendor Managed Inventory, VMI. Vendor Managed Inventory, VMI, also referred to as continuous replenishment or supplier managed inventory, stands out as a pivotal partnering initiative that promotes collaboration and information sharing among trading partners, exploring the various benefits it offers. 20. The VMI technique gained prominence in the late 1980s through adoption by industry leaders such as Walmart, Procter & Gamble, Nestle, and Electrolux Italia. Vendor Managed Inventory, VMI, represents a strategic supply chain approach, where the vendor assumes responsibility for determining optimal inventory levels for each product and establishes suitable inventory policies to ensure seamless inventory management. This approach proves advantageous to retailers by furnishing them with a competitive edge. It translates into heightened product availability, and service levels while concurrently reducing the need for extensive inventory monitoring and minimizing costs associated with the ordering process.